The following is a presentation of TFNN.
Good afternoon, folks, and welcome to our March 28th edition of our webcast. Looks like we have a majority of our clients are catching the archive of this. First order of business, I did send out a update and had typed in to the system at a couple minutes to 3 to go ahead, and we're going long the S&P. I chose the UPRO, which is the triple of the S&P. We'll spend, and what I've got up on the screen here is the ES Mini, the 30-minute chart that I had drawn this morning. You can see that what we did was the S&P moved down into our target area of that 1393, which was the 1.272 expansion. What I was looking for, and we're going to talk about today, is the candle signal that we were looking for, and that candle signal was coming into play just as we were coming on the getting ready to come on the air. That was the candle signal right here at that finished up at 3 o'clock, which is a bullish engulfing candle. So you can see this bullish engulfing candle on the 30-minute chart happens to engulf 3 trading sessions, and we are back above the apogee line. And so we've got everything that we needed. We did obviously have the ES Mini come down hard into the 12 noon time frame when it came down and tagged the first time that it tagged the 1393 area. That was the time to go ahead and not enter the trade because of the way that the ES Mini came down. The next candle that it had out here is called a bullish harami, which is actually it's the Japanese translation of it. Has to do with I think they referred to it as like a Japanese pregnancy, meaning that this would be the mother and this would be the belly. So, but that's not a signal. That is it's a fairly decent indicator, but it is not a confirming signal in my opinion. It does show that the move on the way down is slowing down. So I did want to see that type of a candle formation as the market moved down here. But what we really wanted to see was a candle signal, such as either the bullish engulfing or the hammer candle. And we're going to go back and take a look at last Friday as I was doing the Master Trader program in Denver and what was occurring there. So we got our confirmation here at 3 o'clock. So the UPRO is a trade that you can get into. We'll take a look at the other ETFs out there, but since this is based on the S&P, this is the trade. So I do recommend that you go ahead and enter the trade. I'll put the UPRO up here real quick, and as I was indicating to go ahead and buy that at 258 or so, it was trading out at about 83.85 or so. And then it moved up fairly quick. So when I sent the tweet out, the Twitter alert, Steve, you have on another ETF, UPRO. Did I send out the wrong thing? No. Yeah, UPRO. UPRO, that's what I've got up on the screen. So I'm not sure what the question there is, Christy. And this is the 5-minute chart that we're looking at. So UPRO is the equity that we are looking at going long, so you can go ahead and you can take that trade. That is the triple. That's the triple ETF for the S&P 500. So let me. So, anyways, welcome. So I wanted to make sure I got that out there. When I did send out the Twitter, the text alert, I put in there 84. I believe it was 84.10 or better to go ahead and buy. And let me just put up the daily chart on here so you can see what it is that we're looking at here. So on the daily chart, what we are looking at is a possible ABC up on this. Now this is going to that would also suggest that we're looking at a possible ABC up on the ES Mini as well. So we'll go back and take a look at that. But if I just simply take the most recent ABC, we'd come down to the March 6 lows to the high that was made out on March 19th, and then the pullback down into March 23rd. Now, the pullback that we're looking at here, if we just simply take a look at the retracement that this did, the retracement going from this March 6th area here to the high that was put on March 19th, what you'll see is that's a .382 retracement. And if you have a .382 retracement it suggests that you're going to do more than a 1-to-1. A to B equals C to D. We'll see how this trades. So with more than a 1-to-1, A to B equals C to D, that would take us up in this 97.49 area. We can see here, just on this equity itself, on the 19th, you did about 2 million shares. As you gapped up into it, you did 2.7 million shares. So you actually have, if you were just going to go ahead and play this equity, you would actually have confirming wide price spread with accelerated volume as you came in and got over the actual B point here. So should this pattern play out, a full extension would take us to 97.49. It's trading at 83.97. If you would like, you can play the SSO, which is the two-time ETF, and I'll go ahead and put that up here on the screen as well. We can take a look at what the SSO is doing. I believe that's probably trading out at something a little bit lower, $57. So if we're going to take a look at the SSO out here, let me get this stuff off my screen. It really would be the same type of ABC pattern. So you'd be looking at the low of March 6th down at the 52.90 area up to the high on March 19th. It did 5.8 million shares, and then the pullback here. And so if we take a look at the volume here, you did 5.8. Now, the high there was 58.98. When you came into it, you actually closed at 59.06, 5.6 million versus 5.8. So you came into it with the accelerated wide price spread, meaning that you had the gap up here, 6.3 million down there. Testing it today was 6.9. But we're basing this trade, folks, off of the way that the ES Mini is trading. So if I was going to just go ahead and I'll just finish out the trade here for you on this. This would be the SSO. So let's assume that you entered at the SSO right around 57.88, and our target price on this would be 64.26. So I'm going to go ahead and pull the position size calculator up here on the screen for any of you that might prefer to take this trade instead. So we'll go ahead and put in the SSO. Whoops, let's put the capital on it. SSO. Go ahead and hit the search button. It'll pull up the ProShare double ETF, and we're going long this. 10,000 would be what I done, and what I used so that you can base your number of shares purchased based on every $10,000. What you'd be looking at is a 1.6 minute expansion. So let's complete this. 57.88 or approximately would be your entry price, and the exit price of 64.26 approximately. We'll hit the calculate button, and so it would be 42%. So you're looking at about a 4.6 to 1 reward to risk. So those of you that would prefer to trade the SSO, you should enter right now, in my opinion. Your hard stop should be at 56.50. You can use 1% risk. You're looking at about 75 shares or so per $10,000 in capital. So feel free to take that trade as well. So let's go back here now. Let me just so that was wanted to quickly get into the trade, and then we'll come back and take a look at that and cover exactly why we've entered that trade, what we were looking for. So again, this is our March 28th edition of the webcast, and our next one will be 2 weeks from today. What we're going to do today is focus more on the apogee lunar phase, as far as talking about any lunar phase aspects of today's session that came into play with regard to today's trade that we've entered into, the areas that we're going to go ahead and cover today, some client questions that were sent in, and thanks to each of you that did send in some questions ahead of time. I appreciate that. We're going to take a look at the ES Mini, the apogee lunar phase, that which we've traded. We're going to take a look at the sacred geometry calculations that I did, maybe better explain those to you, what I was doing there. Take a look at the trade that I did not get us into, but how that worked out, the confirming signal, very similar to the trade that we took today. The beautiful patterns that are present on this 30-minute chart. Likewise, if you trade the futures, you should be long the ES Mini. And that, quite frankly, folks, is the better of the trades. And we'll do a session or two on trading the futures contracts. That would be the better trade versus trying to play these ETFs here, where you've got the markets closed for 2/3 of the day, or more than 2/3 of the day, almost. At least we'll figure the market's open 6.5 hours versus nearly 24 hours of trading. So my preference is to teach you to trade the ES Mini, especially when we're taking a look at the patterns that we have here. Reason being is that you can have a better stop money management in place on these trades. And then we'll take a look at questions and answers, if you will, of any questions that you have. So let's get to the client questions that came up first. And this was sent in asking me just to discuss the subtle but important difference between liquidity flows versus volume characteristics at swing points, pattern completions, retracements, expansion zones. So I'm going to try to cover some or all of that. Again, just said another way here, the volume characteristic can be trumped by liquidity characteristics. Again, the basic questions here seem to be really centered around here, the Fed, and providing liquidity and whether it's positive or negative. And so let me try to answer this question first the best way that I can. I didn't talk to the individual that sent it in, and if I have not answered it properly, please just follow back up with me by email or by phone. And each of you are able to certainly reach me by phone at any time here in the office. And when you have my emails, it does have my cell phone on that, so you're welcome to call that as well. But the way that I would take a look at liquidity, I'm just going to put up here the New York Stock Exchange. I have a series of charts that we can take a look at, and the way that I take a look at liquidity versus swing points. When I take a look at swing points and volume, it's just strictly by the book. It doesn't enter any liquidity issues. When I take a look at liquidity event that the markets worldwide have been on, I simply go back to the correlation date of November 25th, 2008. November 25th, 2008 was when the Fed first indicated that they were going to be buying the mortgage-backed securities, and as well as a number of other things that they were going to be doing. To me, that's what started the liquidity event. And in the liquidity event, when you're putting money into a market, not that it's not done perhaps all the time, but in this case here, where it's totally broadcast, what you're really just doing is repricing assets. And when you're repricing assets, you need some type of stable currency to be able to understand, what did the liquidity event actually do. So what I have used as what I'll call a stable form of currency is gold. And so on November 25th, 2008, where this red line is inside this bar right here, that's how much, that represents how much gold, how many ounces of gold it would take you to have purchased the New York Stock Exchange. I think the New York Stock Exchange probably is the best indicator of the overall breadth of the marketplace. And so based on that, and forget about some of these other items that I have in here, I don't want to spend any time talking about these corrections and different ways that I took a look at expansions or retracements of prior corrections. What I wanted to basically show you is that if the market had, based on the liquidity that's been injected, if you're going to use gold as the gold standard, the New York Stock Exchange priced in gold today should be trading at around 10,870, I believe, is the number. So right around there, right where this red line is at least when I grabbed this chart earlier today. And you can see that where the New York Stock Exchange is trading here is at the $8,700. How you use that information or what it means to you, it's to me, it's just more of not anything that you would trade off of. Somebody might use it to measure the health of the economy. But, what we're trading here, we're going to be trading, what we do trade are breakouts, A, B, C, D patterns that are either retracements or expansions of swing points, and they don't get too caught up into the fundamental issues that are out there. Now, there's no question that, the market has moved nicely off of the March 9th lows, and one can argue that it was based on liquidity. But the reality is that there are tradable patterns that are out there. I do believe that you should be looking more for long positions versus short positions. But the market's correct. The market's correct here. If we take a look at last May, that's what these highs are right here that our markets made. So I hope that answers part of the question. We will take a look at when I go to the live charts. I'll take a look at the swing points, and swing points just simply I take a look at volume as you're coming into swing points. But we're trading patterns such as the Gartleys and Butterflies, and the Yes Minis got them all on it, and we'll take a look at the swing points as well. Some additional client questions that came out. Would I discuss the use of market versus limit orders for entering and exiting the position listed in the letter? What I do, folks, is I use a trigger system. Some of you may have access to that as well. And I have a system that basically sets up the order ahead of time. That order ahead of time triggers both if the price that I'm looking for, if the equity gets to that price, it goes ahead and actually triggers a market order for me. I don't get too caught up into whether it should be a limit order or a market order because we're just typically dealing with pennies on these ETF. There's not much of a price spread, and I'm just simply not that worried about the penny or two on there. And so I will go ahead and set a trigger mechanism on my system. So when the price gets to X, then it will go ahead and purchase the number of shares. That trigger mechanism also allows me to put in the stops so that I've got both the stop and the exit. And I do recommend, just like in the trade that we have, that if you're in that position or you're taking that position, that you have both the stop in place to if the trade is wrong, as well as the exit stop in place, the exit price in place. That way you don't have to be near your computer. So, others will just simply only use limit orders. And it's really a matter of personal preference. For me, as I say, when I'm near a computer or what have you, and I'm just simply trading live, I've got my order in place, and oftentimes with the system, I just pull the trigger and the order will get placed. Very rarely have I entered I can count them on maybe both hands where I've gotten the exact tick that I've looked for. It does happen, but when it happens, I just consider that to be nothing of importance. So I just simply use a trigger mechanism. When it gets to my price, I go ahead and I enter the price, even if it costs me a few pennies or more. So can I explain? The next question that came up is, can I explain? And I'm doing the questions first because I think these questions are probably pertinent to everyone, and I last time wasn't able to get to the question, so I wanted to make sure I covered that ahead of time because I do appreciate you sending these in. So the question was, can I explain my outlook, why my outlook has turned bullish, whereas in the fall I was taking, when I was on the air, talking on the air, I was talking about the New York Stock Exchange and suggesting that we were in a down channel, which is true, and I'm going to show you that. And so my outlook was confusing, folks, and that's why I put in the newsletter right up at the top exactly what my outlook is, both long-term, short-term, and intermediate term. So here is the question, can I explain what those time differences are? So first, what I want to do is, and so it's a great question. I'm going to come to the text that's inside the newsletter. I made one slight change here. But again, at the top of each of my newsletters, you will see where I'm long-term, intermediate term, and short-term. And the purpose of that is, with the hundreds of clients that are utilizing this newsletter service, some folks are using it just simply to manage their longer-term retirement 401k type funds. And so in using those funds from a management standpoint, in my opinion, you would take a look at different indicators to be in or out of the market. So I wanted to have a real clear definition of that and show the reasons why. We'll go back and take a look at a chart for that. Some folks have an intermediate time period. For me, intermediate time periods are looking at the weekly charts. The longer term is taking a look at the monthly chart. The shorter term is really taking a look at the daily chart. So I may just see if there's room in the heading just to indicate long means monthly, intermediate means weekly, short means daily, or maybe I'll just describe. Maybe I described that. Maybe I did describe that here. Yeah, I described that in the body of the text that's included with the chart that we take a look at. So when we take a look at the and hopefully that is always going to be helpful, so that I don't want there to be any confusion, at least with regard to my market outlook. I don't want there to be any confusion. Maybe I say something while I'm on the air on the radio, and that's confusing to you. I promise you that when I'm on the air and I'm multitasking, if you saw the number of screens or sometimes problems that might come up while I'm on the air, my train of thought could maybe slip, or I might say something that I don't really intend. Heck, I could do that right here on the air right now. So what I do have in writing, though, that is absolutely what I do mean. So as we take a look at the monthly chart here, when I take a look at the monthly chart for managing longer-term funds, the thing that I believe that you should be using are the exponential moving averages, the 50-day and the 200-day. Now, you have to convert those to a monthly cycle, but in essence, that's what I have here is the 50-day and the 200-day exponential moving average. And if I just simply come back here to the highs that were made in 2007, we're right in here in the October time frame, and you can see when the blue line, the 50-day, crosses through the 200, that, folks, says that you should go to cash in your long-term funds. So I would go to those options that you have inside your 401ks and go to cash. You may not be able to go short, or if you can, then you can consider a short mechanism, but you absolutely should move to cash. And you can see here in 2007, 2008, if folks had taken that advice, just simply using that one tool from the true long-term trend, they would have been out of the marketplace at the 1,470-ish level, and would have done very well just simply to have stayed in cash until there was a crossover the other way, where the 50-day is moving through the 200 to the upside. That would have occurred. You would have not been able to have bought right at the bottom, although I can tell you that was kind of a scary thing to do until the market started moving. You would have gotten in a few months later, and even if you had gotten in a few months later, such as the July time frame, you have March, April, May, June. You could have gotten in possibly in June. So June to July you would have been in, and you can see with the 50-day being over it, you would have stayed in your long position. So if you'd gotten in here, you might have got jostled out here until you had this crossover coming into the August time frame. But from a long-term standpoint of managing those assets, to me, this is the better tool to be able to use for that. You can see that we had this crossover here coming as we were coming into 2012. So that is it's nothing more complicated than really just taking a look at the patterns that are out there. Now, additional patterns as we take a look at the weekly chart, what we're taking a look at is you're taking a look at two ABC patterns, one in black, one in blue. The one that's in black comes off of the March 29th low up to the high that was made here in the 2010 time frame. The pullback into July, and a 1-to-1 A to B equals C to D is 1562. You can see how price on this C to D leg, which is so important, is moving well to the right of that, suggesting that maybe it's only going to be 1562 that it hits. Now, 1562, folks, takes you right back into the highs of 2007. And you are up over this B point. And there's, so you're up over that B point, says you should travel to that area regardless of volume. I'm not taking a look at the volume here. There's also a second A to B equals C to D. That A to B equals C to D. The shorter one, which is in blue, that's starting from the July highs up to the May 2nd area, or the May, because this is a monthly chart, the May of 2010 area. The retracement down into October, 1-to-1 takes you to 1433.55. Now, when you're taking a look at that C to D leg, very important to understand how you come off of that C point. In this case here, you came off of it with conviction, and you can see that price is traveling on the inside, whereas here you have price on the outside of this C to D, and it's important to understand the formation of C to D leg, and you can see you're moving on the inside. To me, this says what it wants to do is it, even though it was a 0.786 retracement here, to me what this says is price wants to travel up to 1531. That would then be correlating with this longer term A to B equals C to D. So until we're proven otherwise, this is the pattern that's out there. If you were to ask me how long would it take me to change my opinion, as soon as the chart tells me something different, that changes my outlook, and it should change yours as well. To me, it's just a matter of reading the chart. So to get back to the channel question, here. And again, it was a great question. I'm just coming to the most, I'll work backwards here as we take a look at the channels that are out there. This is and this is a weekly chart that we're looking at. In order to really take a look at true channels versus trends, sometimes when I'm sending out a chart to you, I'm showing a trend line, and a trend line and a channel line is different. When we're taking a look at channel lines, and the best person for channel lines, and the individual who taught me was Bud Rolfs, and so he did extensive work on it. And when you're taking a look at these channel lines, what you want to do is you want to have co-located opens or closes. Doesn't matter. And so you can see as we start up here, I'm not sure which, because I'm not in the live chart, but you can see we're right here at the open of this candle. We're right here at the close of this candle, at the open of this candle. So we have 3 co-located opens and closes. You can see that we have 1 here, we've got 2, and we've got our 3rd and 4th on the downside. So this is the channel that we were moving into. A true breakout of a channel needs to be in the counter trend. This was a trend down. And in January, February of 2012, again, this is a weekly chart, we broke out of that channel to the upside. Weekly chart, to me, means intermediate time frame. How long it will last, I have no idea. The length of time will be based on the new channel that we set up. I have not set up any new channel yet. I don't know that there's really one that I'm able to totally identify just yet, but I suppose there is. I have not. So what you can also see as I take a look at candle patterns that are out there, you take a look at this hammer. This is an important hammer candle. This was tested when you made the lows back here in October. You did that with a bullish engulfing candle, much like when we went long the S&P at 3 o'clock as we were coming on the air here. I can find the only bearish candle on the weekly chart that's out there happens to be this little bear harami. When we came on the air, I was showing you the bull harami, if you will, and those are candles. Here's the uptrend, and then it's an inside candle inside the bar, indicating that the move was weakening, and you can see it did kind of weaken and move sideways for a period of 4 or 5 weeks. You created this doji here. That's the only other kind of, and that's a neutral candle to me. You wait to see which way price breaks. In this case here, price certainly broke to the upside. So to me, that is how I identify the weekly trend. If you go take a look at the daily out here, the daily on the S&P, as you know, as the market did break out, I was taking a look at the price from this bearish engulfing candle to the low that was made here on March the 6th, and took a look at the first upside target being the same dollar amount, that same dollar amount being at the 142.02 area, and I think we got very close to that yesterday. And then, this is a pullback. I don't know. This chart was probably put in here around 1 o'clock or so this afternoon. But what you can see is this A to B leg, the retracement that has been done thus far, has only been a 0.382 retracement. And so we'll watch to see which way price travels. Should the market go ahead and reject lower price and start to move higher? And if that's the case, we'd be looking for our target on the SPY to come somewhere between the 146 and 147 level, the 1-to-1 and the 1.272. And so this is, I use this as one of the tools for my short-term indicator. That's why I'm short-term bullish. I also use the Mcclellen Oscillator and Summation Index. Some days I go ahead and include this in the chart when it, or in the newsletter when it's pertinent. And what we can see here, obviously, we know in the NASDAQ and in the NDX, those ticked up yesterday. We were neutral on the SPYs. We knew that the pattern in the ES Mini showed that the market should move down, and then hopefully we have identified some support, and the market should move up from here. And then the Dow obviously did tick down yesterday. I imagine that the Dow will tick down again today, with it being down 88 points right now, but it is off of its session low. So I also use this as a indicator, because this to me is one of the better trend following devices out there. And although I don't have price up at the top here, if you're trading in the direction of the trend, you're going to catch a good part of the move, and the idea is to try to catch it as close to the hook, if you will, as possible. This is just the blown-up area, just to give you an idea of the last 21 days. So that is what I use from the long-term, intermediate term, and short term. I hope that helps you out. This just shows a little bit more of the longer-term channels that were out here. This is going back into 2009 as the market came off the 2009 area, and then that broke that channel back here. Looks like it came down in the July timeframe. So this was the July timeframe. This was a true breakout. And when we broke out of this, the uptrend was over. If this had broken up to the upside, that would have been a false break topside, as they might say. Once you do, you have to break a channel in the opposite direction. So this was a channel that was trending up for it to be a true breakout, and this thing broke out with conviction in July. And so that was at a time when I was on the radio, I was trying to be Paul Revere and tell folks to be careful. It was time to move their money into cash and wait till the market changed its direction. If we go back even further into the 2007 time frame, you can see here was the down channel that it traveled in, and when the market broke out, it really was in that May-June time frame here when it broke out of this channel. So this was the downturn channel. You can see as it broke through here, this was just still a false break to the bottom. This here was the signal that we used. This was the butterfly buy pattern that came in on March the 5th and 6th, and that was the pattern that I used to go long the market back in the March 2009 time frame. So we use, I like to use the patterns that we use to trade with because they're leading indicators versus lagging indicators, and they seem to work pretty well. They work very well. If we take a look at one other question that was out there, was sent in, was since crude may be on its way to 98, would Doug be a buy for a few days? And the answer to that is no. It's so very important to understand what is inside the ETF structures that are out there that we trade. I do have a buy of crude, looking for crude to pull back to that 98 area, just simply because that would set up a Gartley buy pattern. I don't know if crude will really trade down to that level, but it would be nice if it did. And if it does, it will. We'll take a look at the candles as it's coming down there, much like the trade that we put on today. But if you were to go to Yahoo Finance as at least as a resource, and you were to type in this case here, if you typed in DUG, I don't think on the left-hand side where you would put in holdings, it would give you any data. So you need to know what the counterpart to that is, and that's the DIG. So if you put in the DIG, I just grabbed this from here. These percentages here are not going to be accurate. If you go to the actual ProShares, I believe Doug and Dig are ProShares, you can go to their site, or it's the iShares, I believe it's the ProShares. Then if you go to their site, you can pull up the exact weighting structure inside any of these ETFs as of the prior evening. You can get them shortly after 4 o'clock. So the Doug is really trading these oil service holders, ExxonMobil being the lead dog, Chevron, Schlumberger, and each of these are having a hard time. So there's the answer to that question. Great question, and I appreciate each of you that sent in those questions so that we could review that with everyone. As far as March lunar phases, the one that's really most important is this one that came in on Monday. That was Apogee. And I know that all of the folks attending the Master Trader, we had a trading plan for that, and they did well by entering that which came in at 1 o'clock in the morning, and we had the market move up pretty substantially early on the following day. Real quickly here, please go back and take a look at the archives. The last I think we have 18 or 19 hours worth of archives now. I believe they're all very good educational pieces of information for you, where I discuss a lot of either lunar or celestial or planetary aspects. What I do use is the New American Ephemeris 2007-2020, Starcraft Publishing. What you want to do is you want to make sure that the version that you grab from them, because they have several versions out there, is the one that includes this, the Daily Aspectarian. That'll be at the bottom of the chart. This will be the more useful ephemeris that they sell for you. So 2007, 2020. Here's the phone number for StarCraft Publishing, and make sure you ask for the one with the daily aspectarian. The lunar cycles, you've got these are the perigee. I'm just going to run through this real quickly, and then the next one, perigee and apogee. These are the ones that you really want to pay attention to. And here are the 2011 dates that you can use to place on anything that you might trade. These ones here have been adjusted for Eastern Standard Time. These dates here, I just simply keep forgetting to do it. These are in ephemeris time. So if you're taking a look at anything right now, you need to back it off by 5 hours to convert it to Eastern Standard Time, or how many ever hours to get into your time zone. When we're talking today, we're talking about the basic candlesticks. And so on a candlestick, you've got an upper and lower shadow. I call these wicks, and then you have a body. This would be my version of a red candle. Oops. That would be my version of a red candle, where you open and you close here. This is my version of a green candle, which would be white. Probably I should color those in. These are the different bullish candle patterns. The one that we were looking for confirmation to go long the ES Mini, or in this case here, the SPYs, we did it through the ETF U Pro. We were looking for either a bullish engulfing or a hammer candle. We did get the bull harami that came in that gave us an indication that things might be slowing down, so that was good. So we got all the patterns that we needed. I won't spend any time on these bearish candle patterns, but again, go back to the prior webcast where I spend more time on each of these, the hammers and so forth. So let's go let's first, I want to throw up the current chart and just see how things are trading, because I've been speaking and have been actually watching what's going on. So I'm going to go over to the ES Mini here. And on the ES Mini, what we were looking at, just for any of those folks that are not new, but who have joined us, let me show you the trade that we're looking at that I put out into this morning's newsletter. So we had the pattern that was forming. That is the area here that shows up at least in pink on my screen, or a purple. And what we were looking at was really very nice sacred geometry. Now, first thing that we started with was the ABC pattern, that A point right here. And you can see this 0.5 represents a 50% retracement. So a little bit more than a 0.382, but not enough to a 0.618. And when we drew the ABC, what I was able to, was not sure which way price was going to be, whether price was going to trade on the inside, to the downside. What was most important about this ABC, and therefore was not sure if this was going to be a 1-to-1 or a, we did talk about UPRO. When we took a look at this pattern, we weren't sure whether this was going to be a 1-to-1 or 1.272 or possibly a 1 to 1.618. What I just simply did was took a look at the retracement area and this apogee area that has, certainly held for all but one 30-minute trading session as a area of support. And what, again, as the ES Mini was coming down and was making this long-ranging bar into the 1.272 area, even though it gave us our price, that was not the time to enter the trade. The time to enter the trade, this was time to be patient and wait to see what other information the ES Mini would send off to us. This candle formation right here that followed, again, that was the bullish harami. And then we got our real confirmation as we were coming on the air at 3 o'clock with this bullish engulfing candle that took us above the apogee, exact time of when apogee came in, and gave us a three candle engulfed, bullish engulfing candle. So what we had was a Gartley buy pattern, nice sacred geometry. Yes, 0.707 was close enough to the 0.786 and the completion of this A to B equals CD down. And the reason why you'd want to be in this trade, truly trading the ES Mini, is because, overnight this thing could make its way up to this 0.618 area. Its next stop really should be 1402. And as it gets into this 1408 area, 1409 area, which would be normal, we'll just simply have to pay attention to the candles that are out there. What gave me also the indication this morning, as I was putting together the newsletter, that we were looking at an AB equals CD down, was this candle formation here that created the C point. This was an evening star formation. This is a 3 candle, and this is a good reversal pattern. So I was pretty comfortable as I was writing this morning's letter that we were going to see this pattern unfold. And as we took a look at the time frame, what this looked like is this would unfold coming into the close today, sometime around 4 o'clock or 4:30, I believe was the approximate time frame that I was looking at. As this thing was coming down lower, we were not going to enter the trade until we got a confirmation candle. That's why we entered the trade. Now, what I want to do here is I'm going to go ahead and back up a bit. I want to cover the trade that was missed, if you will. I gave this target area here of 1378 to 1384, and I did that target area, folks, probably was well before it was established, meaning that I made that target area sometime on March the 19th. Sometime after March 19th, I probably was March 19th in the morning when I sent out the newsletter. That target completed, if you will, on the 22nd. So 3 days ahead of time, I was identifying an entry range, a target for us to take a look at taking a long position in the market. And I want to show you what I was doing. I was using nothing more than sacred geometry. And what I was doing was just taking a look at contractions and expansions of swing points. And that, folks, was starting down with this swing point right down here. Let me get this on the screen so it's a little bit, make sure everybody can see this. Give me one moment to just adjust the size here. Okay. So when we take a look at this, we're just simply coming off of the low of this swing point, using my retracement tool all the way up to the high that was made on the 19th. If I do that for you, in essence, live here, was just simply going from there to there, and you can see 0.382 coming right in here at 1381. So I just simply identified that meant that it was a 0.382 coming into the 1381. That was nothing more from the low to the high out there, and I did that for all of the what I consider to be major swing points, and to see what price range those were coming in. So this 618 was coming in at 1378. Off of this swing point, a 786 was 1379. So it was telling me that we were, and this was a 1-for-1, and this was the actual breakout area that we had here. The 0.786 off of this swing point was at 1382. So what this, and these were expansions of swing points. So I mean by expansion, if I come to from this swing point to the top, and we take a look at an expansion, that's expansion on the way down. You can see 1377 and change. That's our 1378 that we identified. And so all I was looking for, I knew what the high was, which was already established when I was writing the newsletter, March 19th. I did not know if that was going to be the ultimate high that was out there. In fact, I believe in the newsletter prior to that, I was using a high somewhere back in here, and then I adjusted it for the following session. And that way, if the market did move down, that this was going to be a likely target range, a likely area to go ahead and take a long position. And what the market did was, off of this swing point right here, not off of this one, it made if we take a look at the ABC pattern, A to B equals C to D, and what this did here was it made a little bit over a 1 to 1.272, A to B equals C to D. But what it also really did was, off of this swing point right here, made this nice butterfly pattern. Now, as it was doing that, it was completing that pattern at 11:30 on March the 22nd. And then what happened was there was no, as it made this pattern here, no real confirming signal, as far as a candle formation was concerned. The candle formation that came in to give us a signal was actually right here, this session right here, this hammer candle. Remember, as you are completing a pattern, and that's just going back to one of the questions that was asked earlier by one of our clients that sent those in advance, that your ideal thing is to wait for either a bullish or a bearish, depending on whether you're going long or short, candle formation. Are you always going to get them? Absolutely not. But when you do get them, it's just your second opinion. In this case here, we got that hammer candle, and there are a number of different ways that you can trade that hammer candle. And I go into that a lot at the Master Trader series. But what we can see is, as the market did pull back down even into it, this hammer candle worked, acted as support, and you got your confirmation because you had a test of that, and that was coming into the 11 o'clock time frame Eastern Standard on Friday when I was at the Master Trader course. So, but that was really our signal to have gone ahead and taken a long position based on this set of patterns here. Now, what did the market do? The market then goes ahead and makes a little bit above a 1.272. It actually completes the 1.272 butterfly pattern. That is what's here in yellow. Then as it completes that pattern, moves sideways, moves up just a bit early in the morning, 4:35 in the morning, and really didn't give us a real confirming signal that the market was ready to move down from there. Well, I don't know what I just did here. I really screwed that up, didn't I? Sorry about that. Not sure how I did that. Let me see if I can draw that pattern back in. There we go. That's a version of it. I'll clean it up later. So what you're looking for, just as we had back here, we had that hammer candle that confirmed at a projection of a butterfly. That's your confirmation, and again, no guarantee that this trade here is going to work out. But we did get what we wanted to. We had our projected price. We were ready to go ahead and take action as soon as we got our confirmation candle. And and these patterns work they work very well. So let me see if I have anything else here in my arsenal to look at. Let me go ahead and pull up. Let's go take a look at JC Penney, the way that is actually trading today. And so if we take a look at JC Penney, we've got 10 minutes to close. The volume today is 2.6 million shares, testing the heck out of this hammer candle. I had 4.8 million shares. So we've got several bullish candles out here that are at the bottom. If we didn't have so many bullish candles, I might consider getting out of this trade. But we just have, it's not moving. It is certainly not moving off of this. We've got this support right here. We've got these nice 3 bullish candles. Today's volume with the market pulling down, actually, I didn't like the market action 2 days ago. As the market was moving up, this thing was doing basically nothing other than testing the hammer, so that was okay, but was very concerned. Yesterday we did get the bullish engulfing. Today with it pulling back as the market was pulling down, maybe 120 or so on the Dow, this thing from a volume standpoint was doing a pretty nice test. I see that there's really not a lot of time left before I have to sign off. So if there are some questions that you have, please feel free to go ahead and put those into the system, or type them in, if you will, because I'm not going to get to the rest of the charts that I've got in here, although there's probably not that much more that I did want to cover. So I'm going to go ahead and put the live charts up on the screen here. So if you do have any questions, please feel free to go ahead and type them in. And as always, you know how to get in touch with me. If we take a look at just the ETFs, let's see what we're doing ETF-wise. The ETF on the SPYs. Let's go take a look at that. See what it was doing. So today you've got 126 million shares. You were coming into this area here that's got 183 million shares. You've rejected this breakout. You came down here. You closed the gap. So what did we do today? We closed the gap. Now it came down to that candle. It's only got 120 million shares, but you closed the gap. And let's hope that this, I use the word hope, but let's go ahead and look forward to this trade working in our direction. Okay, so EXM. I don't know, Eldon, how did you know the time of today's entry ahead? Well, pretty good guess, huh? No, it was not a guess. It was looking at this. It was nothing more than, if you take a look at my charting system, today is the 28th, and when I was looking at this A to B equals C to D, completing in this time frame here, this 1-to-1, I was looking for it to complete coming into, it gives you the time. You can see like If you look at my cursor right now, it says 1630, which would be 430. You see, it says the 28th, 1630. Right now, it says a price of 1393. So I was just doing nothing more than take a look at A to B equals C to D, and if it maintained this price point, this leg coming down here, then we would have been in the 430 time frame. So it was nothing more than not having any information more than, when I was on the air at about 9 o'clock or so this morning was when I said it looks to me like it would be in the 430 time frame, where this thing would be moving down to. So that's how I did that. So the question, I'm not sure what the question on EXM is, but if I just will pull that up on the screen here, if the question is, should we get in the trade or not? My answer right now is I have to go take a look at the rest of the sector, but there is not a pattern here that I would see. I would like to see on EXM, just like how can the Bradley model affect the UPRO trade? Well, the Bradley model first has to work, and I'm going to trade the patterns that are in front of me, folks. I use the stars and I use the planets, if you will, as triggers, but I don't use them to guide all of my trade. I'm aware of them, but if we use stops, and if the trades go against us, they go against us, and I'm just as happy to trade short and long. It really doesn't matter to me. So I can't get too hung up into the Bradley model or any other astro or lunar phase, with the exception, I will tell you, folks, if you want to make a lot of money, go take a look at apogee and perigee, and especially start paper trading or learn how to trade the ES Mini, because that will make you'll be grateful that you just heard me say that again, and you will be a happy camper. Now, you need to understand how to trade the right side of it as you're in it and where your exit strategy should be, but those are things that I'm able to absolutely teach you. So, folks, it's a few minutes before Tom's show comes on, and the producers need to go ahead and grab this so that we can get this uploaded for everyone else that is going to be looking for the archive. So, folks, thanks so much. As always, enjoy being here. I look forward to speaking with you in a couple weeks. If you have any questions, just give me a call or send me an email. And have a great afternoon, a great evening. Take care. Bye-bye now.